Hey everyone. Today I want to talk about why you should not invest in individual stocks. Now, there's one caveat to this that I will cover at the end of the video, so do stick around for that. But I want us to start by thinking about playing a game. Have you ever played a guessing game where you have to guess how many items are within a jar? Maybe there's jelly beans or M&Ms or some other item in a jar, and you have to guess how many are in there. A lot of people will have done this in maybe a class at some point, but one of the interesting things that comes out of this exercise is that you find out that while individual guesses were all over the place, the average response of the group is actually pretty close to how many items are in the jar. Here's an example of results from a jelly bean guessing contest that I got from an article published in Financial Analyst Journal. A finance professor named Jack Trainer, who's actually a very famous professor and developed the Trainer ratio, but we don't need to get into that here, showed his students a jar full of jelly beans, and they were asked to guess how many were in it. As is common when playing a game like this, individual responses were all over the place. Some people guessed very low, some people guessed very high. However, when Trainer took the average of all guesses, that number came out to be 841. What's amazing here is that the actual number in the jar was 810. Obviously, this is very close. And in fact, it turns out that of the 46 students in the class, only two had guesses that were closer to the true number than the class average. In other words, the average of all students beat almost everyone in the entire class. And you may be thinking, okay, so the class happened to get lucky in this case. So what? But what's really neat about this type of game is how incredibly common this result is. I've done it in class with students and had similar results. Many others have replicated the game. That's quite literally why it gets played so often in class. And in the same study I mentioned previously, Trainer actually repeated his experiment with another class of 56 students. And in the second experiment, the class average was better than the estimates of all but one student in that class. Now, this experiment is a great example of the concept of collective intelligence or wisdom of the crowds. There's some interesting statistical explanation for what drives this, but from a more practical perspective, it just turns out that collectively, we can actually be more intelligent than we are as individuals. But I told you this video is about why you shouldn't invest in individual stocks. So why the heck am I talking about jelly beans? Well, the reason is that the stock market is a lot like one big jelly bean guessing game. People all around the world are looking at the same companies and trying to estimate their value. Only in this case, it's like a jelly bean guessing game on steroids because you have millions of investors all around the world effectively looking at the same company and trying to guess how much it's worth. On top of that, this isn't just some fun game that everyone's playing, but instead a game where there are fortunes to be made from finding even the smallest opportunities in the market. If you aren't someone connected to the finance industry, I think it can be easy to not appreciate how much time, effort, and money is going into constantly evaluating stocks. Wall Street attracts some of the most brilliant people in the world. There's an interesting story about Bill Gates back when he was the CEO of Microsoft. Gates was asked by a reporter what competitor worries him the most. His answer? Goldman Sachs. The reporter was surprised by this answer, but Gates explained that Microsoft is in an IQ business, that they have to win the IQ war, and that he saw investment banks like Goldman Sachs and Morgan Stanley as actually his biggest competitors in that battle. You have economists, physicists, mathematicians, all trying their shot at finding any edge they can get in the market. On top of that, you have some pretty wild stories out there about firms going to extreme lengths to research companies, cases of firms using corporate espionage to try and gain an edge, or even stories like high frequency trading firms investing incredible sums of money trying to move as close to Wall Street as possible, or even investing in cables that try to get as close to light speed as possible so that they can just cut nanoseconds off the transmission of data and gain an edge.
They can predict the price of a stock before you can because of the speed that they're using.
How much faster do they see it?
It could be a few milliseconds,
How much of an advantage is a couple of milliseconds?
millions, if not billions of dollars a year.
I hope I'm not belaboring the point here, but I just want you to understand how cutthroat Wall Street is. Now, let's go back to our jelly bean game. Imagine you're playing a jelly bean game, but instead of everyone being on equal footing, you're playing that game against some of the world's largest financial firms with armies of highly skilled employees and technology that is far superior to yours. Would you really feel great about your ability to beat those firms in identifying good investment opportunities? So when I have Joe Blow in Cedar Rapids, Iowa, telling me he's got a great beat on the biotech market and he knows which companies to invest in, you see why I find that a little bit ridiculous? Come on, man, please. And I don't mean any disrespect in saying that. I am Joe Blow from Cedar Rapids, Iowa. Well, not anymore. I used to live there. But my point is, I'm not elevating myself above them. I have all sorts of credentials and experience that would give me some footing for trying to suggest that at least I should be far ahead of the average person when it comes to investing in stocks. But I'm still just Joe Blow. Compared to Wall Street, I'm a nobody. I would get slaughtered trying to compete against them. And if you happen to be watching this video, chances are you would too. Now, that doesn't mean there's nothing we can do as individual investors to try and enhance the returns of our portfolios. Check out my video link below for some ways that I think we can strive to outperform the market as individuals. But trying to pick and choose individual stocks is just not the way to do it. Now, I told you I would have one caveat, and that's this. Despite the folly of trying to compete against Wall Street, investing in individual stocks can be fun. It can be exciting. It can get people motivated to save even more for retirement. So my caveat would be that if you're already saving enough for retirement through conventional means, and by that I mean mutual funds, ETFs, and similar well-diversified investment vehicles, then if you want to go above and beyond what you're saving and have some extra funds to put into individual stocks, then by all means, have at it. Now, what do I mean by saving enough? I personally love frameworks like Dave Ramsey's Baby Steps or the Money Guy's Financial Order of Operations. Just for example's sake, let's look at Ramsey's Baby Steps. So let's say you're young, you've gotten out of consumer debt, you've built up a fully funded emergency fund, and you're saving 15% for retirement. If you already had this baseline in place and you want to push your savings rate up to, say, 20%, meaning 15% is going towards traditional savings and 5% is going towards individual stocks, then I think this can be a reasonable route to go. The beauty of this structure is that you're still in a great position, even if you lost everything in your individual stock investments. At the same time, particularly when you own just a smaller number of stocks, you're introducing some possibility for some very sizable upside growth through a more concentrated stock portfolio. Now, everything I just mentioned was assuming that someone was getting a relatively early start. If you're 50 and just getting started saving for retirement, chances are 15% isn't going to get you where you want to go, and you might need to be putting any extra dollars you can towards traditional retirement savings vehicles. But the main point here is that you really need to understand just how competitive Wall Street is, and you really should have your core retirement savings going into conventional investments before you start getting crazy and adding in individual stocks. And I know it already, some folks are going to jump in the comments with stories about people they know who got rich trading individual stocks. Yes, it can happen. It does happen. But you know what's also true? People who have success investing are much louder about their success than their failures. People don't get famous on TikTok talking about their mediocre portfolio that underperformed the market, or that time they lost a ton of money investing in a stock. No one wants to hear that story. They get famous talking about some major success they had. And then people who are perhaps themselves striving for or aspiring to achieve something like that themselves latch onto that story. So the next time you're tempted to invest in some individual stocks, I hope you'll pause and give thought to investing in individual stocks as really one big jelly bean guessing game. Is that a game you really think you can win? Well, what do you guys think? Leave a comment in the comments below, or if you have a question, leave it there, and I may answer it in a future video.